Greetings and welcome to the latest edition of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners re-domesticate out of volatile legal and tax environments like the formerly golden state of California to more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are reviewing a recent report by the Financial Times entitled Billionaires who fled California wealth tax risk intrusive residency audit, referring to the ongoing exodus of businesses and people from California, as I have reported in myriad earlier presentations on Legal Bites. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications covering accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, the Financial Times reported recently that billionaires who left California ahead of the forthcoming Proposition 40 wealth tax vote are now facing what that publication called intrusive residency audits by the California Franchise Tax Board. I will be the first one to tell you this is not limited to billionaires. I have seen the California Franchise Tax Board aggressively pursue small and medium-sized business owners years after the fact. And if you own a business entity that is still domiciled in California, this story should concern you far more than you might think. Here's what happened. California's 2026 so-called Billionaire Tax Act, also known as Proposition 40, proposes a one-time, though it's not going to be one time, but a proposed one-time 5% tax on global net worth, not California net worth, not income, global net worth of California residents whose value exceeds $1 billion. The tax is on the November ballot. It will almost certainly pass. The residency snapshot date is already in the past. That's January 1, 2026. That means if you were a high net worth California resident on New Year's Day and the measure passes in November, congratulations, you owe the tax even if you left the state the next day. That single clause created, as we covered in earlier episodes, a late 2025 decision window for roughly 200 affected individuals. 6 of California's estimated 214 billionaires reportedly left before or around the deadline. Google co-founders Larry Page and Sergey Brin relocated their personal holding companies to Florida. Page purchased over $173 million in real estate in Miami's Coconut Grove neighborhood, which is a pretty nice place to be, by the way. Brin acquired a $51 million mansion on Allison Island. Peter Thiel established residency outside of California. The founder of Uber left. Larry Ellison sold his San Francisco residence and moved to Nevada. Although, as we will cover in an upcoming presentation, it sounds like he may be headed to Tennessee. But more on that at a later date. Zuckerberg acquired a $170 million estate on Indian Creek Island in Miami, not far from Jared Kushner. But leaving is not as simple as buying a house in Florida and changing your mailing address. Oh no. The California Franchise Tax Board is not letting these people walk away without a fight. According to reporting from multiple outlets, the Franchise Tax Board is conducting some of the most invasive residency audits in its history. And by the way, all of the techniques I am about to describe to you, I have seen them applied to single member LLCs and individuals who are firmly in the middle class, even lower middle class. So do not think this is just a rich guy's problem. It is not. The agency is demanding mobile phone GPS records, Apple Pay transaction locations, ATM withdrawal receipts, bills of lading from moving vans from over 7 years ago, and even veterinary records. That's a hard word to say, veterinary. I'll just say vet records for family pets, all to determine exactly how many days an individual spent in California and whether they have truly severed ties with the state. This is not just a paperwork exercise. It has real world legal and tax consequences. The Franchise Tax Board completed 520 residency audits in 2023, which is the most recent year for which we have good data, more than the same pace, actually more than double the same pace as compared to 2019. And the standard for proving non-residency is high. For example, a taxpayer must demonstrate abandonment of a prior California domicile. No, you cannot keep your California house. And frankly, why would you want to? In view of these facts, physical presence in the new location, yes, you actually have to be in the new state, and intent to domicile there permanently. The Franchise Tax Board's own guidelines, which in my view are unconstitutional, but nobody listens to me, make clear that the taxpayer bears the burden of proof. Now, here's why this matters if you are not a billionaire. The Franchise Tax Board, as I said previously, does not limit its enforcement activity to individuals worth $1 billion. Every business and every individual in California, even on a temporary basis, is subject to California jurisdiction. Every California LLC pays the minimum $800 annual franchise tax, regardless of revenue, plus a graduated fee that can reach almost $12,000 on gross receipts above $5 million. And the Franchise Tax Board has a well-documented history of pursuing entities with even minimal connections to the state. If you have relocated yourself and maybe your family to another state like Florida or Nevada or Tennessee or Texas, but your LLC or corporation is still domiciled in California, you have a big problem because your entity is still a California entity. The Franchise Tax Board still has jurisdiction. You are still obligated to file California reports and returns. You are still paying California taxes. Your personal move did not move with your company. Now, with this context in mind, redomestication is the lesser known legal process of transferring a company's, as opposed to a human being's, a company's state of domicile to a new state without dissolving it. That's important. Without creating a new entity and without triggering federal income tax consequences, but only when performed within the strict formalities required by the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of the destination and departing states. And let me stop here. All day long, I get calls and emails. Well, California doesn't allow redomestication. Yes, they do. They have allowed redomestications for LLCs for many years and for corporations since 2023. So if your CPA or attorney is telling you, oh, yeah, California doesn't do that, they are way, way behind the ball. In a properly performed redomestication, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. That is to say, there is zero operational or financial disruption. I have successfully completed redomestications from all 50 states, including California, and for limited liability companies, partnerships, subchapter S entities, and subchapter C corporations. And not to brag, but we do have a 100% success rate to date, although who knows what the future holds. Foreign entity registration is not the same thing as redomestication because foreign entity registration, also referred to as foreign qualification, does not change the company's domicile. If somebody is using these terms interchangeably or saying, oh, you move your company by filing a foreign entity registration, they don't have a clue what they are talking about. Run, do not walk out the door and seek better advice. Foreign entity registration, in fact, does the opposite because it keeps the entity in the former state, California in our example, indefinitely and merely adds another layer of compliance and tax obligations in the new state. Meanwhile, a traditional merger, which is also not the same thing as redomestication, creates a new distinct entity in the destination state, may require the issuance of a new federal employer identification number, and can trigger serious tax consequences. Finally, dissolution should not enter the conversation at all because dissolution terminates the company. The other day, I was on the phone with a prospective client, and they were proudly bragging that, well, they're going to save me all this time and hassle because they went ahead and dissolved the company earlier that day before we got on the phone. And I said, well, sorry, I'm not going to be able to help you for a couple of reasons. First off, dissolution is a going out of business mechanism, not a relocation mechanism. And by the way, I wasn't a jerk. I sent them referral information to people who could help them. But dissolution means there's nothing left to move. You do not redomesticate a dissolved company. As I said, it is a going out of business approach, not a relocation mechanism. Dissolution is often a taxable event, and when performed incorrectly, can expose, get this, can expose the owners of the company to unlimited personal, emphasis on the word personal, joint and several liability for the company's liabilities, known and unknown. Now, you might say, well, nobody's suing me, I'm good. Well, you don't actually know that until the statutes of limitation have run for all of your contracts and other liabilities. So if you have a so-called professional suggesting dissolution as a relocation mechanism, again, seek better advice. Redomestication, when paired with a change of personal residency and this is an important and, especially when it comes to California, and a reduction or outright cessation of business operations in the former state, can reduce or even eliminate state tax exposure there for the entity and its owners. Don't take my word for it, ask your CPA, and if you get a blank stare, it might be time for a change. Now is the time to consider acting before the California State House in Sacramento considers changes to the law to hinder or even eliminate the option of redomestication. If you have questions regarding potentially redomesticating your existing LLC or corporation out of California or out of another state, please use the link in the description for more information on this process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information illuminating, probably a bit frustrating, but hopefully it was informative if nothing else. As always, the information in this presentation is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on these topics, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. And I look forward to that opportunity to speak and perhaps even work with you very soon.